Investors are prone to make mistakes regardless of the level of experience they must have obtained in the market. It's only that the more experienced we are, the lesser the number and magnitude of mistakes we tend to commit. But all the same, mistakes are bound to occur and nobody is exempted, including a value investor. And that's why I want to consider 10 costly mistakes in value investing and how these mistakes could be overcome. Number one, value traps. When we talk about value traps, you're considering companies that are selling at a price quite below their intrinsic values. Generally speaking, companies are cheap for a reason. We don't just rush and buy cheap companies because we feel they are cheap. It's important we investigate why these companies are cheap. Is it because of temporary fundamental problems, or the reason could be something quite permanent in nature? We need to ask ourselves these relevant questions so as to avoid, getting involved in value traps and obtaining a lesser than stellar performance at the end of the day. Number two, overconfidence in valuation. A value investor could tend to have overconfidence in the fact that he has done his research, his analysis, and he feels that this company, is cheap compared to its intrinsic value. Sometimes he may be correct, sometimes he may not be. That's why it's advisable that we employ different valuation methods so that we will not end up making mistakes. And not only that, we need to equally consider a margin of safety. After researching a particular stock, analyzing a given security, we need to kind of, incorporate a margin of safety. In other words, we should make provision for the fact that we could be wrong, we could be mistaken. That's an important way we can overcome this particular issue of having too much confidence in our ability to analyze a given stock. Number three, neglecting market sentiments. Market sentiments actually are something we need not to neglect because investors are essentially sentimental in nature. They don't seem to think rationally or logically when it comes to investment. Sometimes they discard logic, they discard reason, and they just they make purchase or sell decision based on pure emotion. And so we should then we should not neglect the fact that this kind of behavior can affect stocks and security values in the short term. Though we are long-term value investors, but we should not overlook the impact of market sentiments, in our portfolio performance. Number four, ignoring company management. This is a mistake we should learn not to commit, because at the end of the day, discover that the result we are going to get from the market will be based on the quality of the management team. We need to look into the quality of the management team. We need to analyze their track records, integrity, historical performance, corporate, governance, their approach to corporate governance. All these things are very important because, a high quality management will tend to produce a high quality result, and a mediocre management, unfortunately, will equally produce a mediocre result. So no matter how cheap a stock may be, as it relates to value investing, we should not forget to consider the quality of the management behind that particular stock, or else we may end up having a kind of result that will not be palatable at the end of a given financial year. Number five, overemphasis on historical data. The dilemma here is that we make investment decisions and choices based on past data, and sometimes past performance. And we are making that decision in the present, and we intend to have a future result that is positive, that's encouraging based on our past information. And so we don't just rely too much on past data. We should also consider current market trend and recent development that could impact the companies we are investing in, even at the current moment. We should avoid over reliance on past data or past results. We should equally incorporate what is obtainable at the present moment so as to have a better result. Number 6, lack of diversification. The fact that we've gotten cheaper stocks to buy in some few sectors, that isn't well enough. We should try to diversify our holdings across different sectors and across different industries so as not to have our portfolio devalued because of the performance that could be less than expected in the sectors we've placed our investments. And so this particular concept is very, very important. Learn to diversify. No matter how cheap a stock is, look at other sectors and equally incorporate stocks from other sectors and other industries and even other regions into your portfolio. It's a very good idea. Number 7, short-term focus. The issue of having a short-term view of the market, short-term horizon, ought not to be accommodated, because if you're operating on this particular principle, there's a tendency that you will then overlook what is the bigger gains you could obtain in the future, and simply concentrating on what you could gain in the short term. So have a long-term view of the markets, have a long-term view of what compounding could do to the value of your investing. Don't be carried away by a short-term trend. Don't rush to sell your stock because something is not really performing well in the short term. No, don't do that. Be focused on the long term. Be focused on the fact that over some years to come, your investment will perform more than what it is even currently. So avoid short-term behavior. Number 8, failure to reassess. You may have made very good investment choices in the first instance, in the initial stage. Don't fail to reassess the narrative behind the stocks you've bought. Sometimes conditions do change, and company performance equally are prone to changes. And if the narrative behind which you buy the companies has actually changed, then of course you need to reassess your investment in that company and consider whether to sell or to buy additional units of the company you've earlier invested in. Don't just invest your money and go to sleep. No matter how cheap you bought in the first instance, there's always the need to reassess the performance of the stocks in your portfolio. No matter how you must have gotten it at a cheaper rate initially. Reassessing and rebalancing is very important. Please give me a thumbs up and subscribe to this channel, and don't forget to press the notification button. Equally, make your comment in the comment section. It will go a long way in guiding me on what to do next in this channel. Number 9, emotional investing. As human beings, whether we like it or not, we are prone to making emotional decisions despite our discipline. Sometimes you may be tempted to be emotional. Sometimes the market could be fluctuating drastically. Stocks could be going on a downtrend. The ability to really stay put and not be tempted to sell their stock is something every investor should imbibe. All right, and so make decision based on logic, based on reason, and not based on fear or greed. These are two negative emotions many investors tend to have. So let us not allow our decision making to be based on fear or to be based on greed, but let it be based on reason, on logic, and that will help us to be able to stay disciplined to be able to obtain the kind of results we have set for ourselves to obtain in the market. And then lastly, number 10, ignoring competitive landscape. Ignoring competitive landscape. Companies don't operate in an island. Every company has a competitor or a group of competitors. We need to ask ourselves, how are these competitors affecting the performance of the market, of the company we are invested in, or how will they likely in the future, negatively impact on the result, the companies we are invested in will likely produce. We should not disregard that. Sometimes, if a company goes into a kind of, becomes complacent, then, competitors around will take advantage of that and then increase their market shares and take market, shares from an existing market leader. And so you need to be very, very vigilant to make sure that your company, your investment is doing very well, in the given competitive landscape. And as we consider all these mistakes and avoid them, I'm believing that we are going to become, better value investors, and we'll have a kind of result that will be mind-blowing, that will make this effort I'm putting in to bring this content, it will not be in vain. I will please that in the comment section if I apply this particular, these particular points I've explained, and then that would then go a long way in giving you the kind of result that will make me happy, even as a teacher.